You're able to see the screen?
Yes, we can.
Good to go? Hi there and good day. This is Sunil Subramania here. Welcome to the second part 2 of our July edition of the E.M.I Economy Markets Investments. Today we'll be focusing over the next 45 minutes on the equity markets. Largely I'm going to spend my time on the domestic markets, and if some time permits, I'll try and talk a little bit on the international side too. Right? So let's straight head into the market performance. Right? What I'm going to be trying to do is trying to demystify it and understand why the market is behaving. I know a question that's a burning question in everybody's mind, and let's see if we can find some clues in the course of today's webinar. Right? So as you can see, this is yesterday's stock market index performance. And as you can see there, you can clearly see the difference between the red and the greens, right? The red represents negative returns and the green represents positive returns. So as you can see, all the indices, whether it's large, mid, or small, or the broader market, were negative 6 months, 1 year returns, and in 3 years, mid and small caps were deeply negative. But 1 month and 2 months, you see grain all over the place. So what's happened to the world? Why is this stock market over the last 3 months suddenly showing positive? And mind you, this is not just across the large caps, mid caps and small caps too. So as I said, the market performance seems to be at odds with the economy's performance. What is this economy performance you're talking? If you see from 2014 to now, Indian economy GDP went all the way up, and then started coming down for the last 2 years. And you see what is the main thing dragging? Government expenditure has somewhat sustained the GDP growth, but capital formation and private consumption, right? Both have kind of collapsed. So this recessionary phase was well before the COVID, right? And hence, when recently the IMF came up with the actual estimates of growth, can you see there in 2018, we were at 6%, 2019, we dropped to 4.2%, and this year's projection, for the first time in many, many years, our domestic economy is headed for a recession this year. So overall, on an economic, a very thanda economy for the last few years, and the recent past is also obviously not very good. Obviously, the earnings of the stock market, now we have a full picture of the earnings for the last year. Earnings reflect this slowdown, right? So if you take the full year earnings, right, overall market, right, the first column that you see here, the first set of rows, right, the sales. The sales tells you about the slowdown in the economy. When this economy drops, company sales drops. So you take overall market was down flat about 1.5%. If you take the banks away, it's about 3.5% down. Operating margins were hurt, and EPS or PAT growth down double digit, whether it's with banks or without banks. So clearly the full year has been a very, very not so good year, if I may put it that way. In fact, the quarter 4, if you take from the full year earnings, take the quarter 4 earnings, because for 2 reasons, right? The COVID started in February. We went into lockdown in March. So the company earnings there will give you a clue as to how deep the damage was and what's the outlook for the next quarter too, right? So the massive COVID and lockdown impact is clearly visible in the quarter 4 trend. So can you see, as opposed to just a slight flat sales drop, this was a quarter had a 7% overall market, stock market sales was down. And the earnings, EPS, is down 45%. So have no doubt on how deep the impact of this coronavirus and the lockdown has been. So in this situation, market, if you take the 1 year returns, what I showed you was the returns as of yesterday, but you take the 1 year returns to give you a sense of how things have moved. I've shown in this table, right, the 1 year returns and the 3 year returns as of December 31, which is the pre-COVID phase, right? How is the markets behaving pre-COVID? And then you have as of March 2020 when the COVID impact came. So you can see there itself that from greenish, it has moved to reddish, but the right side, the last column gives you the COVID impact. As you can see, the impact was brutal in the month of March. In fact, your large caps got hurt more, 38%. Your mid caps were slightly less and small caps were slightly less affected. Actually, large cap got beaten badly. Why? Naturally, because FIS pulled out the money. And the 3 year returns shows roughly the same. These are absolute returns, not annualized. So the markets did reflect correctly and expected economic impact of the COVID crisis, right? But look at it from a sector perspective, right? Again, the same December to March comparison. By March, every sector had turned into red. But if you look at it from a COVID impact, and I've given the rankings there, as you can see, FMCG was the least impacted. Pharma and healthcare was the next. Whereas if you take the bottom of the 13 sector list, realty, which is high risk, high reward, oil and gas, and banks, because the NPA problem naturally was breathing down the banks in a COVID scenario. So the market correctly reflected in March the bad news. But what is the likelihood for the future? Now, Q4 earnings are likely to be repeated in Q1 of 2021. So the near term, because the lockdown was continuing, gradually the economy is coming back to life. At the time, why would the market not be expecting a bad earnings quarter? It was. But the markets have shown a strong bounce back from April onwards. So the same, I've used March as the base, and I've taken the 1-year returns and the 3-year returns. Can you see that as of July, the 1-year returns were continue negative, but look at the V-shaped recovery in the markets. And what is 2 things I'd like to point out? That is, whether it's 1 year or 3 year, the returns have improved dramatically. And interesting point, which we'll cover a bit later, is small cap has shown the best recovery, followed by mid cap, and then by large cap. So very, very, very counterintuitive and interesting for us to study, right? This same bounce back is seen even in the sectors. And I'd like to point out to you, which are the sectors which have bounced, right? You see, pharma is number one. Reasons I spoke in my last webinar, right? Because the expectation of a vaccine or a cure, and a lot of that manufacturing to come to India. What is two? Auto, high risk, high reward sector, right? Backed by interest rates and backed by people wanting to consume. Who's number two? What is number three? Tech and IT, right? So look at the bounce back, how it's happened in the sectors where it has happened. That will give you a clue, right? So now, why is the stock market showing this bounce back after the March correction? To that, let's look at the Indian economic outlook, right? When I talk about Indian economic outlook, obviously, how we have handled the coronavirus crisis is critical, and we took an approach of a long and a severe lockdown. Why do I point this out and I've highlighted it in blue? Because that lockdown caused its own economic damage, right? But the lockdown succeeded in curtailing the spread of the coronavirus to just a few containment zones, the red spotted zones. So by and large, real Bharat, rural India, whichever way you want to call it, in green, by and large got protected, right? But only issue here from an economic perspective is that our GDP is very concentrated in the containment zone. So while the rural economy is expected to recover fast, significant portion of the GDP is concentrated there. Why do I point this? Now you'll realize why auto is jumping up, because auto is a very rural sales oriented, whether you two-wheelers or you take cars, you take tractors, right? So clearly demand. So those segments of the rural oriented economy are expected to recover faster, partly reflected in the sectoral bounce back story, right? So the story then for India is that we are now successfully held the lockdowns and towards an easing of mobility restrictions and resumption of economic activity. Unlock 1.0 and 2.0 have commenced. So all of this we talk about, are there actual green shoots available that tell us that this is indeed the case, right? So this gives you a set of frequency indicators, right? I'm just showing it to you to tell you that across a range of subsectors, there is a improvement May over June and last week to latest. So there is a sign of normalization returning. Beyond that, I don't want to dwell on this too long. Next, e-way bill. The government purchases through e-way bills, interstate transactions take through e-way bills. Can you see after a sharp drop, there is a gentle recovery. So increasingly, you're going to see this pattern of what I would call a V-shaped turnaround. So I will keep pointing out the V's, you can keep looking for those. So there are signals. So what is the beauty about a V is that the V tells you there's a sharp drop, but there's a reasonably sharp rise also expected. Take electronic toll collection at highways. You can see the V shape clearly. Yes. Next, the TV ads index. Can you see? It doesn't look like a V because there's a lateral. It's looking like a reverse L, rocketing because people are spending more time on TV. So TV ads have actually gone up because that's the way marketers prefer as a medium. Unemployment statistics, India, urban, rural, all three here. Can you see it's an inverted V because it's unemployment, right? So it had shot up in the COVID scenario, but today, can you see unemployment has come back to the pre-COVID levels. There is some writing on the right-hand side which will clarify this to you. I'll leave it on for 5 seconds if you want to read that, and then we proceed to the fact that there is a business resumption index which Nomura, a stockbroker, leading stockbroker, manages this index for us. They're saying that just prior to the lockdown, we were at 68 in that index, and now we are at 69. Yes, the economy was at 100 at some point in time, but at least the immediate impact of the coronavirus has been taken care. We are back to pre-lockdown levels, right? And some high frequency indicators. This is called a heat map. So Feb, March, April, May, June, a series of indicators. Again, I'm leaving it there. I'm not going to go through it in detail, but I just want to tell you that where you look at a green, it means previous month to this month, it was better. Where it is red, it was worse. Yellow is neither here nor there. So if you see what's happened in February to now, prior to that, prior to the lockdown, it was obviously green, then it dropped. But can you see that closer to June, there is only one sector, credit growth, which is in red. All the rest are in their yellows, or some, in fact, two-wheeler sales and tractor sales and have actually moved to green. So this also tells you that there is a recovery. And if you see in the first few days of July, there is even a power demand has gone up, and EV bills we already talked about. So general story of how the economy is gradually coming back to normal. And then the government announced a massive relief package. I covered it in detail in my last webinar, but just wanted to give you an update that on all the measures that they announced, there is significant progress on the right-hand side. So all the government's actions are beginning to filter through into the economy, whether it is in terms of lending or refunds from the tax or what. They're trying to put more money in the hands of the people. So there is good progress on the government's relief package, right? So as a result of this, what do we expect is the economic impact on India's GDP in the short to medium term, because earnings will follow this recovery. So as you can see, clearly from a pre-COVID, pre-lockdown phase to 13th April to now latest, there is a gradual sharpening of the V, which means that the fall was not expected to be as deep when you began, but it showed itself and the rise is expected. So in numbers, look at it, we'll rely on the IMF's data to talk about 2020, right? I told you that we were minus 4.5 projection, but in very next year, 2021, IMF is saying India is going to jump back to a 6% growth. So the delta is almost 10.5% in terms of the GDP growth. So that's the V-shaped recovery in front of you, which is what the market is looking at. At the same time, let's spend a minute or two on the longer term economic outlook. Why is this critical? Because markets react to that because there is a lot of longer term money, whether it's from pension funds, provident funds, whether it's from sovereign wealth funds, or it's from mutual funds. A significant portion of the portfolio is on the longer term outlook. So to study the short term market move, you need to understand the long-term economic outlook. And there, I spoke about this in detail last time. I will quickly rush through it today for your benefit, is that the China opportunity is actually arising from the strong structural advantage India has over China. Starts with the labor. China, as you can see, the red line, their labor is declining. India is still rising. India's decline starts from 30 years later. So for 30 years, we are assured of a strong labor supply, which China is not. Next, China is actually going to lose in 10 years' time 21 million people. We are adding 115 million people to the working age. These are people already born, so not an issue. So clearly way above the rest of the world in terms of labor supply and labor cost. Labor cost, China is at $10,000 per capita GDP. We are at $2,000. So 1/5 cheaper as compared to China. Then the skill set, thanks to our English and our technological education, engineering colleges, IITs and everything, whether it's basic, moderate, or advanced skills, we have adequate people to take care of any kind of work in the skill pyramid. Right. Next, India's rankings on the ease of doing business have jumped up 79 ranks compared to the rest of the world. We are the most improved country on that. And finally, for foreign investment to come in, tax was a big hurdle. Our 35% tax rates were a big hurdle compared to the rest of the emerging world. We dropped it to 25 for existing companies, but more importantly, for new manufacturing companies, we have dropped it to 17%, which, as you can see from the graph, is the absolute best in the world. The only one comparable to us is Singapore, right? So all these put together, plus the fact that government has given lots of exemptions in terms of DDT removal, in terms of tax exemption to sovereign wealth funds to get foreign capital in, we are today, whether it is financial attractiveness and people skills and business environment, to add it all together, we are among the most attractive countries globally for manufacturing to come to India. And based on this, right, we have seen FDI flows will be expected to come in. So let's move to the markets on that basis. Just to summarize the economy, we are expected to have a 4.5% negative this year, but a 6% positive next year. And the longer term outlook is favorable because of the opportunity from China on a structural basis. So for the markets, then let's look at it by market capitalization. So as I already showed you this strong bounce back, I wanted to dwell on it again, right? Just to tell you that what are we looking at here? We're looking at the fact that all the indices have bounced back, but actually the smaller cap and the mid cap have bounced more than the larger cap indices. So first support for the market was that FII outlook is turning favorable to India. So if you look at it here, the flows into India in January, February, March this year, 6,000 crores was the outflow. Not 6,000 crores, it was sorry, $6 billion. This is in dollar million, was the outflow. But in April, May, June, $4 billion has come in. So from April, suddenly India has become favorable. Why? As I said, long-term FII money is looking at long-term India's economic outlook. Second, they are also looking at the V-shaped recovery and saying that India, with a 10.5% delta YOY GDP, is a beautiful place to buy because stock correction has made them cheap. Yes, in Q3, July to now, there has been a little bit of profit taking by FIIs, but overall, the mood is very positive towards India. So why is this? As I said, positive long-term outlook, but there are some more whys here. What is that? A favorable currency outlook. What do I mean? Crude price drop implies rupee stability because 80% of India's crude requirement we used to import and we continue to import. So any drop in price from the $80 levels to $30 levels is a big, big advantage to our currency. Second, the currency has already weakened almost 9% in a year. So longer term, our currency weakness is only going to be around 5% as per the interest rate parity principle, which I've laid out here. The 10-year GSEC India compared to the 10-year GSEC US, if you see consistently, whether it's right last week or March or December or September, is hovers around 5%. In the long term, rupee depreciation follows that. So as you can see here, longer term depreciation is also hovers around 5%. So since this year, the depreciation already been 9%, the near-term outlook is that the rupee cannot weaken much in a shorter term time frame. So next, what is a favorable valuation? Two comparisons, intersay with the world and with emerging markets, and long-term average of India's own market from a foreigner's perspective. We'll come to the Indian perspective a little bit later. So India has always been at a premium. So if you see here, the topmost line is the premium with respect to emerging market, clearly a strong premium, and the next line is a premium with respect to the world, slightly lesser, but still a premium. But what is interesting is that that's because India is always a darling of the FIIs because of our long-term growth potential. But what has happened is that got corrected. So can you see both the lines drifting down over the last few months? So that correction led to a buyback, and then you can see that V-shaped recovery happening in the premium. So India's attractiveness seen in the consistent premiums went through a correction. Next, if you specifically look at it as a 12-month forward discount versus the emerging market, right? You can clearly see how it had dropped below the long-term average of the premium, and now the buying has taken it back to the long-term average. So valuations are a strong support on an intersay basis. On a long-term historical comparison basis, as you can see, the top graph gives you the long-term average and the MSCI India's P ratio. P ratio is just at the long-term average. So we are not very expensive, which we were just a few months ago. Just go back in time. But what's more challenging and interesting here is that on a price to book, we are trading at a discount. What is the beauty of that? Because India's capacity utilization dropped from the 76, 77 to 69%. So what the foreigners are betting on is that when India needs to get back on sales, we don't need fresh capacity immediately. We have adequate capacity. The price to book value tells you that value is there in the Indian companies. Same, so the foreigners, though they don't invest much in mid caps and small cap, MSCI runs a mid cap index and a small cap index. So I'm using this to show the view of India, where you can see that the mid cap long term average, we are trading below the long term average, and in price to book, also the same story. So from a foreigner's perspective, the mid cap scenario is looking cheaper on a historical basis. On the small cap, the recent rise meant that it went slightly below and it's now at the long-term average, but on price to book, it's still at a discount. So overall, from a valuations, whether it's inter-se valuations or it is historical valuations, from a foreigner's perspective, India looks reasonably valued. So hence, the EPS growth, the world V-shaped recovery, the Nifty, which is the FII's main domain, right? This we are seeing over 18 to 21, 2018 to 21, the Nifty earnings have been flattish. 0.2% CAGR. The very next year, can you see how sharp the forecast for the earnings for the next year is 21-22, right? So that's what the foreigners are keen to buy, this sharp bounce back in earnings in the following financial year, right? So the V-shaped recovery coming to play here, right? But this whole favorable FI outlook does not explain the sharp rise in mid and small caps at all. Why? So I'm just showing you the gross inflows the mutual fund industry got. Then we look at whether they're buying or not. So look at it here. So if you look at it, April, May, June, equity flows gross were about 14,000 crores a month, roughly similar. Hybrid category, which is your balance fund, balance advantage fund, got about 2,000 crores a month. So total about 16,000 crores a month we got. Half of this was through SIP book, which you've seen there's a small correction there. From 8,300 has gone to 7,900. And lump sum has been steady at around 8-ish, right? And then there is ETFs. What have I excluded from this? I've excluded arbitrage funds because they don't contribute to market gain or losses, right? They are hedged positions. So barring the arbitrage, the entire equity portion is here. And you can see ETFs, in fact, have been strong flows. Why do I point this out? Just a curiosity for you is ETFs are mostly large cap, right? So most of the ETFs are large cap ETFs. So just look at it. This is the gross inflows to the fund house. Now, obviously, there are redemptions. So it may not be true that AMC gets the money and AMC itself suffers redemption, somebody else. But the net is what actually results in buying in the stock market. So let's look at the net inflows. Now the story is very different slightly. What's happened? If you see the one clear standout, hybrid funds have been negative, and they're not just recent. They have been negative for a long, long time, almost a year and a half, 2 years they've been doing. And the reasons for that are well known to everybody because they used to pay regular dividends and then the dividend tax came in and now it's taxed in the investors' hands. So it has lost its charm as a thing. So hybrid category has seen outflows. But look at the equity category. First 2 months, April, May, about 6,000 crores net flows. But last month in June, 400 crores. Whereas ETFs have shown a continuous rising trend. Why is this? It's because the provident fund money, both of private sector and government companies, are being put into ETFs and equities. That is the only thing which is on rising. So clearly you get a clue here that one side that mutual fund ETFs are getting large cap money, right? Still not an answer to our small cap story, but let's take the story a little bit positive. What did the mutual funds do with this money? Now here if you see Q1, that is, I've not shown the data of flows there. Let's assume that they were decent. When the FII sold, I said $6 billion, that translates into crores, into 48,000 crores. So FII sold in Q1, 48,000 crores. Derivative action was also negative forwards. Mutual funds bought 39,000 crores from FII sales. So arguably, what is the thing here? Arguably, in the first quarter, mutual funds went and bought the large caps that the FII sold. Right? Then look at the financial year to date. Right? I've split it up as Q2 and Q3, but let's look at it consolidated. FIS bought 24,000 crores. As I said, FII outlook to India changed dramatically in April, but mutual funds actually sold 6,000 crores. So first of all, While that sale is obviously somebody buying and somebody selling, net, mutual funds since April have pulled out money from the stock market, right? And so that doesn't answer the key question which I asked in a couple of slides before. So what did they buy? So now look at the story, right? So the large cap impact, this is the fall. Since large caps corrected 38% for mutual funds, they felt that these were solid, good quality, safe companies where the correction has taken place. So after the correction, they bought. That's why their purchase did not prevent the market correction. So the last week of March, when the correction happened, they went and pumped in the money. So that explains the mutual fund. So having spent all their money into large caps, you saw they did not get much money. So if you then analyze this, the flows, the net flows, right? What is the net flows? Let me take you to that slide here. The net flows for the industry were about 12,600 crores, right? I'm showing you that. Now I've changed that figure to your 14,000 because what I have done is I've added the equity component of the hybrids also and done some. So if you see now, large cap is 66% of the net inflows into a mutual fund. So customers like you have given 9,400 crores into large cap. Mid caps is 800 crores, small caps only 900 crores. Yes, in the multi-cap segment, fund managers can buy small cap or mid cap, right? But you can see dominantly the money that the mutual funds have got in this quarter, April, May, June, is predominantly large cap. And if you actually analyze that mid cap funds are allowed to buy 35% large cap, and that multi-cap funds can buy a mix, and hybrid, the equity component of hybrid can also be a mix. Look at this. I've done an analysis of estimate of the industry in terms of the flows. So if you see large cap funds, 93% large cap, because up to 20% they can buy small caps, right? So overall, because ETFs are 100%, rest of the large cap category. If you see each one, I've tried to estimate what is the component today based on our understanding of our fund house and our industry pattern. The bottom line gives you the answer there. But 74% of the money in the mutual fund is meant and has bought only large caps, only 18% has bought mid caps, and only 8% is there to buy small caps. So what accounts for the rise? The answer lies here, my dear friends. In the post-COVID scenario, with the lockdown in place, retail investors, HNIs, with a lot of time in their hand, and maybe money also there, have been buying stocks directly in the stock market through digital stock brokers. So if you see here, I've shown the first line, if you can read it here, Zerodha. In March and June last year, they had just under 1 million customers, 0.98. This June, it has doubled to 1.94 million customers, right? ICICI Securities has gone from 0.84 million to 1.12. 5 Paisa Capital had only 11.11. They have gone 5 times up. So can you see that this market, small caps and mid caps are rising, not because FIS are buying, not because mutual funds are buying, but because direct retail digital investors are just going and buying based on stock market and stockbroker and TV channel recommendations, right? So if you see the earnings of these people, it has also sharply, their fee income has gone up, reflecting the same story. So as a result, domestic MFs have not captured the post-COVID rise, as their portfolios have actually increased the safety large cap component in this period. So you see, even in large cap, they have not managed to beat the index 1 month and 3 months. Like this is the category average of all the large cap funds in the industry, all the mid cap funds, all the small cap, taken from a commonly available website, valueresearch.com. I've taken the category average. So as you can see, the average mutual fund in the 1 month and 3 month has not been able to specifically beat the small cap and mid cap and large cap. Why? In the case of large cap, the answer lies in 2 things. One is that ETFs buy everything, mutual funds don't buy everything in the index. Second is one particular stock, as you know the name, has sharply risen and is now 14% of that index, but mutual funds can't take more than 10% of any single stock due to regulation. So any rise from 10 to 14 of that particular stock, they lost out of. It's a very simple explanation for that thing. But in mid cap and small cap, they have not been improved. Why? Because they haven't bought and they are not present in those, right? And what is the reason? If you look at it, I have broken up the earnings. See, why mutual funds have taken this safety call? What is the logic? Because they are basically fundamental approach, right? People with fundamental approach, analysts, mutual funds, everybody has a fundamental approach, not a technical based approach. So if you look at it here and look at the last year's earnings, I've broken up the same earnings that you saw a few slides ago into the large cap, which is the SEBI-defined large cap. This is not the Sensex or the Nifty or anything like that. It's the top 100 stocks. The next 150 are mid caps, and the next below 251 and below are small caps. So can you see the dramatic damage there? I would urge you to look at the PAT line on the right, where large caps have had about 5% negative growth last year, but mid caps had 84% negative and small caps 47%. Now, this is the full year last year. That's the story. But if you look at the quarter, the last quarter earnings, which gives you a good guidance for what's happening in the next quarter or maybe 2 quarters also. Large cap earnings were down 26% in the quarter, mid caps 58%, and small cap earnings 167%. So can you see that this, and the bottom left, it tells you that it's not a small sample. It is 1,916 companies that we have taken and put it here. So what I'm trying to say is that there is absolutely no fundamental basis to assume that next quarter, the earnings, especially of mid cap and small cap, is going to be any better. If at all, the same pattern or even worse is going to continue. So hence the confidence to buy a mid cap obviously will not be there, and it is the right thing. But these retail stockbroker driven investors have gone and been buying things which they see at a 52-week or a 104-week low and going and buying. Time will tell whether that's going to be a sustainable one or they're going to panic at the next market fall. But that's the lay of the land. That's the reality of the situation, which all of you must understand. So at the same time, mutual funds are observant of this. Over the longer term, they generally come and they deliver that alpha. So if you see even today, after this recent missing the 1 month, 3 month, right, that has its impact right over the longer term. But still, if you look at a 5-year plus 6, 7, 10 years, whether the category average in mid cap or category average in small cap, they have handsomely beaten. In fact, over 10 years, they are giving you 3.5 or 5.5% additional returns over the benchmark. So fund managers, because they are fundamentally driven, over the long term make the right calls. In the short term, very often situation happens like this where they are not keeping track of the market. So in just to demonstrate this, I'm putting up there our Sundaram equity fund and its positioning, right? As you can see here, these are our multi-cap funds. So I want to show you where we have a discrete. My mid-cap fund, I have to buy mid-caps, right? Small cap fund, I have to buy small cap. But if you see our diversified equity, large and mid-cap and equity fund, where we have the flexibility to shift across the cap curve, we are at anywhere between 62 to 77% large cap. This is reflective of the industry. I just wanted to demonstrate to you how, in the absence of any strong confidence in the near-term recovery in the economy, mutual fund managers are actually playing safety, and hence to the extent that risk has come back in the market by buying by retail investors, they have not captured it. Right? So now let's move to the sectors. The reason I want to focus on the sectors for you is because this large cap, mid cap, small cap, all that is fine. But a fund manager doesn't blindly buy a large cap, mid cap, or small cap. Fund manager studies sectors and buy stocks within sectors. So first, the sectoral outlook works. So on that perspective, this is a feel for what are the various sectors of Nifty, Nifty mid cap, Nifty small cap, which are the dominant sectors. So as you can see, the top line in everything is banks or finance. The second varies. In Nifty, it is software. In mid cap, it is consumer non-durables. In small cap, it is software. So it varies. But the top one is banks, right, in the index, just to give you the sense. So now this gives you the March slowdown. Yes, as I told you already, it showed, and which is the ones we already discussed this. The bounce back, here if you see, like what has not bounced back, banks have not bounced back. right? The red ones are not. Realty has not bounced back. Power is not bounced back. The V-shaped recovery, the highest recovery has been of healthcare, for reasons explained, tech and pharma, and auto, as I already discussed, right? So giving you again Sundaram Mutual's perspective of how we see it from a sector, these are the sectors that we are overweight on. And if you see the small number saying 24, so a quarter of the NSE 500, if you take the weightages, 25% we are overweight. Well, this gives you an idea about our risk apprehensions, right? And our fund managers, however, are given some flexibility. So the same overweight, there are funds which are underweight. So it's not like we put a one rule for all the funds. The fund manager can exercise his discretion, but I wanted to give you our view, and then this is the story of the funds. I don't want to go in detail on our funds here. Where are we underweight? We are underweight on 39%. So 24% we are overweight, 40% we are underweight on all these sectors, right? That's what I wanted to show. At the same time, the fund managers are given flexibility. So even in an underweight sector, you can see some greens that there are some people who have taken a overweight position. So 24 plus 40 is 64. The balance 36% is where we are neutral, and this is where we are flexible. That if you see a change, for example, if you notice there, last month we were negative underweight on auto. This month we have moved to neutral. So that's what I said. Fundamentally, when we see the situation on the ground changing, then we change our view. So this 36% is the flexible portion. 24 overweight, 40 underweight. So why I'm saying this is, this tells you that neutral to overweight, we are at about 65% of our portfolio, right? And again, a range of colors here tells you that individual funds obviously carry their own thought processes, right? Thus, the stock market is showing this bounce back after the March COVID correction. Why? Expecting a V-shaped economy and supported on the large cap side by strong FII flows and by strong retail direct equities inflows. So now let's look at the valuations intersect between the large cap, mid cap, small cap to see what this has done and where you should position your portfolio, because that's where I'm going to head towards. So this gives you the historical comparison of the valuations with their respective long-term averages, Nifty mid cap, Nifty NSE mid cap, and BSE small cap. So if you see there, they are all trading slightly at or above their long-term valuations, but they are not way above as they were a few years ago. 2 years ago, you can see all were trading well above their thing. So the market is not in a very rich valuation scenario from a historical perspective. Next, if you look at it, the expectation of V-shaped recovery and look at it from where we were. So the V-shaped recovery, to demonstrate to you, I've shown here these same three indices. The 1 year forward P, that is the market expectations in December 17. So, and you can see Nifty was at 18 PE, mid cap was at 24 PE, small cap was at 19.9, 20 PE. Current PE ratios are given there, right? Now, how do you explain this change in the PE ratio? How much is that change? If you see the very last column on the right, Nifty PE is flat. Only a half it has changed. Mid cap PE has corrected 9.3x and small cap PE has corrected 5x. So clearly mid cap is where the valuation has corrected the most. Now you look for the reason is a forward expectation of the earnings. What has happened there? Large cap forward earnings, what they were predicted in December 17 and today, no change. EPS expectations are flat. Mid cap, however, there is a 14% improvement in the expectations of the earnings, but still the valuation has corrected 9. Whereas small caps, actually their earnings outlook has decreased from 968 forward earnings then expected to 821 today. Despite that, the EPS correction of 15% has been only reflected in a PE correction of 4.8. This is where it comes in. What is the reason for this? Is that these retail investors going and buying these small cap stocks. So today you're in a situation that if you compare the premium discount over Nifty for a mid cap and a small cap, both are trading at a discount, which means that relatively you can buy. But believe it or not, the small cap is trading at a lesser discount than the mid cap. So clearly that same reason that direct investors coming and buying stocks which are recommended to them saying it's fallen a lot, buy, is reflected. So that with that in mind, if you look at it from a calendar year basis, the mid caps and the small caps have had 2 bad years in a row. This year, recent correction upwards should ease the pain, but should end for the calendar year negative. The reason I put up this slide is to tell you that corrections happen recurrently across cycles. I'll talk about cycles shortly, but the rebounds are equally swift. So if you look at the red and then the green, you can see that when there was a 24% fall, there was a 30% rise. In the 40% fall, there's a 35%. So when the rebound happens, the rebounds are equally swift. So bear that in mind when we go to the asset allocation page, right? So now I want to take you to one more point, which is leads on from the previous slide, which is that stock market performance, right, of mid and small caps does better when the economy does better in terms of this, barring this short-term what's move that you have seen from March. So here, if you see, I've done an analysis of the three indices over various cycles in our economy, starting with 2003. When 2003 to 8, you had a very good cycle. And then 8 to 13, we had the global financial crisis and we had a bad cycle. Then the reforms package that Manmohan Singh announced in October 2013, the new bull phase started and went on till December 17. In December 2017, you know, the negative food inflation combined with the ILFS and NBFC crisis led to a strong economic correction, which the stock market also has reflected. So what you can see here, I just point to only the left and the right extreme. So the left, if you see, right, virtuous cycle, which is up cycle, good cycle. Sensex was up 49% per annum, mid cap was up 63% per annum, small cap was up 77% per annum. Take the extreme virtuous cycle in the third phase. Again, Sensex up 12%, mid cap up 29%, small cap up 30%. So when the cycle is good, small caps do better than mid cap do better than large cap. Take the vicious cycle in the middle. What happened? Sensex was flat. It didn't lose money, but mid cap lost 8% per annum, small cap lost 30%. So clearly, they do better in economic cycles, do worse in down cycles. And so in the recent vicious cycle, as you can see, Sensex was flattish at 1%, but mid cap lost 12%, small cap lost 6%, right? So that is the state. So if there's a V-shaped recovery and another virtuous cycle starting, which you can see the graph with a small uptick. The same story is that this is the BSE related indices. The same story is repeated in the NSE related indices. Just for information, I want to leave them here. And I want to make the point that when these are managed over a cycle, the fundamental active management of mutual funds adds alpha. So naturally, doing this exercise, I can't take a category average. I had to take our funds. So I've chosen our funds. So as you can see, when the virtuous cycle was up 61%, fund delivered versus 47. So if you see the next virtuous cycle, 15% versus 13%. Yes, in the previous vicious cycle at that time, the fund did not do well. But in the new vicious cycle, as you can see, the fund has been flat, whereas a Nifty 50, its benchmark, has been negative. Active management adds alpha generally. Same with the mid-cap fund. As you can see, virtuous cycle 76% versus 62. Next virtuous 34 versus 28. Whereas in the vicious cycle, it gave a flat 1% return, the first one, whereas the index was down 4%. And in the new one, while the index is down 14%, the mid-cap fund is down only 13%. So can you see active management adds alpha, right? Same with the small cap fund. I will not repeat this very strongly, but as you can see in the last two cycles, the virtuous cycle has been up 39% versus 30, and in the down cycle, it has lost 20%, but the index has lost 24%. So I would still say that when it comes to mid and small cap, right, you should rely yourself on mutual funds to manage, right? So based on this, let's move on to asset allocation strategies, right? So now if you're an aggressive risk reward investor, that's understanding your risk profile is critical when you come in. Aggressive means you're willing to take losses for short to medium periods of time, but in the long run, you know that equity markets pay off. If that belief is there in you as a human being, then you are an aggressive risk reward investor. Even then, in today's scenario, a 5-year horizon is needed. Second that is needed is a flexibility. What do I mean by flexibility? That today I would say, despite what has happened, a 50% exposure to large cap and 30 to mid cap and 20 to small cap is the right for an aggressive investor. But after a year, you can reduce the large cap to 30 and mid and small cap can go 70. So that flexibility is important because in the 1 year, because that V-shaped recovery would become very clearly visible by the end of a year and market would be fully comfortable to take risk. So that's what I would suggest for an aggressive investor. If you want to take sectoral funds, right? I mean, not stocks in the sectors, but sectoral funds. There's roughly the same philosophy, right? In terms of the safer banking, IT, pharma, and half of consumption. In consumption, FMCG is safe, consumer durable, discretionary, and auto are risky. So roughly half of services and infra are something which are cyclical and the uptick of the economy. After 1 year, again, the same suggested strategy. So this is for an aggressive investor. If you are a moderate risk reward investor, then the best option today, because flexibility is the key, is to let the fund manager do that flexibility. So large and mid-cap funds, multi-cap funds, other diversified funds are your best bet if you're moderate risk, because that fund manager will take safety today, as I demonstrated with our multi-cap fund. We are at 70% large cap, but we keep our eyes open, and as the fundamentals become to improve, we can add mid and small cap. So you don't need to redeem from one large cap fund and add it into a mid cap fund as an aggressive investor would have to do, because then taxation, 1 year short-term capital gains, then 1 year long-term capital gains. So should I do now? All that confusion and all you can avoid, and you would safely leave it to them that they can manage the risk return trade-off for you by varying the cap curve and the sector allocation strategies, right? If you're a conservative investor, from a risk reward perspective, then I would suggest that hybrid funds, which blend in fixed income to reduce the volatility, are the best bet. Now you have a range of hybrid funds which are put there. What the range goes is the topmost has roughly 65 to 70% equity to maintain equity taxation. So it has about 35% debt. Balance advantage is a flexible category where the can go 0 to 100 equity debt as a fund manager does it, but they do it not with an idea to give you fantastic returns, but to manage the risk reward. Equity savings have a fixed allocation, 30 to 35% in equities, 30 to 35% in fixed income, and 30 to 35% in arbitrage. Arbitrage acts like fixed income from a risk perspective, but gives you the taxation benefits of equity. So equity savings is very good for a conservative risk reward. The debt-oriented hybrid is the opposite. It has 70% in debt. So volatility is reduced and 30% in equity to give you a little bit alpha. So depending on how conservative you are on this scale, you can rely on these categories of funds, right? So thank you very, very much for your patience. I think I've ended it correctly at about 30, 35 minutes. And so look forward. I will come back to you with the question hour. So I wanted to make a point that, so those of you, not to worry, if you joined late for this will be put up on YouTube for you to look at. So 1 week from now, roughly, I think it's the 30th, that is the next Thursday, we'll be hosting on this presentation. And of course, any subsequent updates that I get in the next 1 week, we'll host a dedicated 45-minute question hour session for you to ask all questions on anything that is stated here on the markets, on fund flows, on valuations, on performances, right? So wish you all the best. Stay safe in this crisis period, and look forward to interacting with you in my question hour on the 30th. Please mark the date on your calendars. 30th, the timing will be intimated through you through our regular channels. Thank you very, very much, and all the best.